We were watching shares of Tesla this morning, the EV giant delivering 440,000 vehicles, beating expectations of 439,000 for second quarter deliveries. Is the fear of slowing EV demand coming to an end here? Here to weigh in on that, we've got Dan Levy, Barclays senior equity research analyst. Dan, thanks so much for being here. Is this a sign that the price cuts kind of worked for Tesla?
Hi, Madison. Thank you so much for having me. I think today's result was certainly an upside surprise. We had previewed 415,000 units. I think what's interesting about this result was we certainly saw some impact of price cuts in the quarter. You look in the US, you had the 1% financing in May on Model Y that likely had a key role. There was additional discounting as well. There may have been some other levers that occurred throughout the end of the month that helped drive this. But look, there is still the risk of further price cuts ahead, and there is still further question on fundamentals. We are still facing somewhat of an EV winter on demand. So good result, but I think the fundamental macro backdrop is still the same.
How deep do you think price cuts could be?
Well, I think that Tesla is taking maybe a more, measured approach on price cuts after what happened last year, where they cut very aggressively, but they didn't stimulate the type of demand that they had hoped. I think they've likely shifted strategy to not be as overt with the price cuts. And so this is why you've seen price cuts on things like via, special financing or inventory vehicle sales, other benefits as well, as opposed to outright price cuts. There are levers to be, to unlock pricing without having outright open price cuts that maybe are a bit more damaging to the residual values.
I want to talk about the China of it all because we are seeing continued success for the Chinese EV makers, particularly in that market, of course. How much does Elon Musk need to be worrying about that?
Listen, China is probably the most competitive region for Tesla. That's the region where they are facing the toughest competition. They're facing competitors that have products that are just as good as Tesla, some would argue even better. From a software-defined standpoint, Tesla certainly doesn't have the same advantage in China that they have in the US or Europe. So certainly the competition is going to be tougher in China, but there is still a place for Tesla in China. We've still seen them hold share fairly steady in that high single-digit range as a percent of total BEV sales. So they've actually held steady, but certainly the competition is intense there.
Okay, we kind of got a little bit of a breakout, or at least a murky number for us to think about with regard to how many Cybertrucks they're producing and delivering. And I know it's early in the game right now for Tesla with regard to this, but what do you think the reception and what we're seeing in these delivery numbers for Cybertruck, which is really just kind of looped into those other models that also include the S and the X, but what does this tell us about what type of run rate and growth we should expect for that part of the business?
Cybertruck is still pretty niche for the business. The vast majority of the volume is still being driven by Models 3 and Y. Those are more of the sort of mass market type options for Tesla. They are ramping on Cybertruck, but right now it is still supply constrained. I think we should have a better sense later in the year and into next year, once the supply constraints are eased, once they can ramp more aggressively, to see what the underlying demand is. We think it's a fairly niche model. We think it's going to be, something in the ballpark of 50,000 units a year, which helps, but is still a very small portion of the total volume for Tesla.
All right, Dan Levy, who is the Barclays senior equity research analyst. Dan, great to have you here with us. Thanks so much for taking the time.
Thank you so much, Brad Madison.